Question 11. What are the types of preference shares? Answer. There are 4 types of preference shares. Cumulative preferred stock includes a provision that requires the company to pay preferred shareholders all dividends, including those that were emitted in the past, before the common shareholders are able to receive their dividend payments. Non-cumulative preferred stock does not issue any omitted or unpaid dividends. If the company chooses not to pay dividends in any given year, the shareholders of the non-cumulative preferred stock have no right or power to claim such foregone dividends at any time in the future. Participating preferred stock provides its shareholders with the right to be paid dividends in an amount equal to the generally specified rate of preferred dividends plus an additional dividend based on a predetermined condition. This additional dividend is typically designed to be paid out only if the amount of dividends received by common shareholders is greater than a predetermined per share amount. If the company is liquidated, participating preferred shareholders may also have the right to be paid back the purchasing price of the stock as well as a pro rata share of remaining proceeds received by common shareholders. Convertible preferred stock includes an option that allows shareholders to convert their preferred shares into a set number of common shares, generally any time after a pre-established date. Under normal circumstances, convertible preferred shares are exchanged in this way at the shareholder's request. However, a company may have a provision on such shares that allows the shareholders or the issuer to force the issue. How valuable convertible common stocks are is based, ultimately, on how well the common stock performs. Question 12. What is working capital? Answer. Working capital is a measure of both a company's efficiency and its short-term financial health. Working capital is calculated as working capital equals current assets minus current liabilities. The working capital ratio, current assets by current liabilities, indicates whether a company has enough short-term assets to cover its short-term debt. Anything below 1 indicates negative WC, working capital, while anything over 2 means that the company is not investing excess assets. Most believe that a ratio between 1.2 and 2.0 is sufficient, also known as net working capital. Question 13. What is fixed capital? Answer. Fixed capital includes the assets and capital investments that are needed to start up and conduct business, even at a minimal stage. These assets are considered fixed in that they are not consumed or destroyed during the actual production of a good or service but have a reusable value. Fixed capital investments are typically depreciated on the company's accounting statements over a long period of time, up to 20 years or more. Question 14. Definition of financial planning? Answer. Financial planning is the process of estimating the capital required and determining its competition. It is the process of framing financial policies in relation to procurement, investment and administration of funds of an enterprise. Question 15. What are the objectives of financial planning? Answer. Financial planning has got many objectives to look forward to. Determining capital requirements. This will depend upon factors like cost of current and fixed assets, promotional expenses and long-range planning. Capital requirements have to be looked with both aspects, short-term and long-term requirements. Determining capital structure. The capital structure is the composition of capital, i.e., the relative kind and proportion of capital required in the business. This includes decisions of debt-equity ratio, both short-term and long-term. Framing financial policies with regards to cash control, lending, borrowings, etc. A finance manager ensures that the scarce financial resources are maximally utilized in the best possible manner at least cost in order to get maximum returns on investment. Question 16. What is the importance of financial planning? Answer. Importance of financial planning. Financial planning is process of framing objectives, policies, procedures, programs and budgets regarding the financial activities of a concern. This ensures effective and adequate financial and investment policies. The importance can be outlined as, adequate funds have to be ensured. Financial planning helps in ensuring a reasonable balance between outflow and inflow of funds so that stability is maintained. Financial planning ensures that the suppliers of funds are easily investing in companies which exercise financial planning. Financial planning helps in making growth and expansion programs which helps in long-run survival of the company. Financial planning reduces uncertainties with regards to changing market trends which can be faced easily through enough funds. Financial planning helps in reducing the uncertainties which can be a hindrance to growth of the company. This helps in ensuring stability and the profitability in concern. Question 17. What is the liquidity of fixed capital assets? Answer. Liquidity of fixed capital assets. While fixed capital often maintains a level of value, these assets are not considered very liquid in nature. This can be due to the limited market for certain items such as manufacturing equipment or the high price involved, as with real estate. Additionally, the time commitment required to sell fixed capital assets is often lengthy. Question 18. What are the fixed capital requirements? Answer. The amount of fixed capital needed to set up a business is quite variable, especially from industry to industry. Some lines of business require high fixed capital investment. Common examples include industrial manufacturers, telecommunications providers, and oil exploration firms. Service-based industries, such as accounting firms, may have more limited fixed capital. This can include office buildings, computers and networking devices, and other standard office equipment. Question 19. What is procurement procedures? Answer. Procurement procedure. While production businesses often have easier access to the inventory necessary to create the good being produced, the procurement of fixed capital can be lengthy. It may take a business a significant amount of time to generate the funds necessary for larger purchases, such as new production facilities, or external financing may be required. This can increase the risk of financial losses associated with low production if a company experiences an equipment failure and does not have redundancy built into the fixed capital assets. Question 20. What are the types of financing? Answer. There are 8 important types of financing: takeout financing, revolving credit facility, evergreening of loan, syndicated loan, bridge loan, consortium finance, preferred financing, guarantee services / non-fund based business.